Okay, let's unpack this. We are diving into quite a stack of deep analyses today. We've got Drewry's terminal capacity rankings, MSI's latest fleet movements, and um, the big annual reality check from UNCTAD's review of maritime transport. Our mission really is to try and get a handle on the global shipping industry. Because right now it seems defined by this massive contradiction.
It really is a genuine paradox, you could say. On one hand, you've got the physical side, the ports, the ships, the carriers investing like crazy, a capacity boom we haven't seen in years.
Right.
But then on the other hand, the actual map of global trade, it's being, violently redrawn. Geopolitics, tariffs. It's messy.
So the tension is, why build all these bigger ports and ships if the trade lanes themselves are collapsing or radically shifting?
Exactly. Why the surge in capacity when the patterns are so uncertain?
So we're tracking these two big trends: the physical expansion, huge investments in ports and fleets, and then this complex, volatile rearrangement of where the cargo is actually going. We need to figure out what this disconnect means, for supply chains, for costs, and ultimately for you. Right, let's start with the infrastructure side. Money pouring in. The sources show this phenomenal push: global container handling capacity. It's projected to jump 4.8% in 2025.
Yeah, and that 4.8%, it might sound like just another percentage point, but well, if you connect it to the bigger picture,
It's a lot of boxes.
it's 64 million TEU being added. And just quickly, TEU, that's the standard 20-foot equivalent unit for containers. That's 64 million TEU. That's the largest annual increase in absolute terms since the global financial crisis.
Wow, that scale is just staggering. Is this expansion rational, or is it just momentum carrying things forward? Like, are they betting on a post-pandemic surge that maybe isn't quite here?
It's probably a bit of both, but mostly I'd say it's a delayed reaction. Remember that post-pandemic peak, the chaos?
Oh, yeah. Ports jammed, costs through the roof.
Exactly. Widespread congestion, bottlenecks exposing huge weaknesses everywhere. So the carriers, the terminal operators, they were suddenly flush with cash from those boom years, and they invested heavily, really heavily, to kind of future-proof themselves against that kind of congestion happening again.
Almost regardless of the demand forecasts now.
Pretty much. They're effectively spending yesterday's massive profits to buy resilience for tomorrow.
Makes sense.
They're betting on continued high-volume global movement, even if the routes themselves change completely. And when you look at who is doing the buying, the spending, it tells a strategic story.
Right, the rankings.
Hmm.
BSA International is still #1 globally for terminals, right? Big increase, too, over 7% capacity growth.
Yep, 67.2 million TEU for PSA. They're followed pretty closely by the big Chinese players, China Merchants, and Costco. But what's really fascinating, I think, is how the global carriers themselves are evolving, the actual shipping lines. We're seeing companies like MSC, CMA CGM, Hapag-Lloyd, they're actively buying up terminal capacity, strengthening their physical footprint.
How are they doing that? Just building new ones?
Sometimes, but often it's through mergers and acquisitions, M&A. The analysts are basically saying that M&A is often the only way these huge carriers can actually get a foothold in established, desirable port markets. It's hard to just build from scratch everywhere.
So it's a power play, isn't it? If you own the ships and the terminals,
You control much more of the end-to-end chain.
less reliance on others, massive leverage.
Precisely. And that kind of aggressive consolidation strategy in the ports, well, it leads us naturally to what's happening on the water. With the ships themselves, we should look at the latest ownership rankings. These are measured by deadweight tonnage DWT, basically, how much a ship can carry. And the shifts are pretty dramatic.
Okay, so who's on top? Still
The Chinese giant OSCO still dominates, yeah. They're the world's largest owner, controlling over 76 million EWT. Massive. But the real story, the headline grabber, is the incredible expansion of MSC Mediterranean Shipping Company, based in Switzerland. They are just defining this whole era of aggressive fleet growth.
How much growth are we talking?
They swelled their fleet by a staggering 9 million DWT in just 1 year.
9 million. Why?
Yeah, went from 35.5 million DWT up to 44.5 million. And they didn't just grow, they strategically leapfrogged Bank of Communications Leasing, jumped right into the #2 spot globally.
That's huge. How does the market even absorb 9 million DWT so quickly?
Well, it really speaks to the sheer amount of cash they generated during the pandemic boom and their long-term vision. Clearly, they're playing a long game based on scale.
So MSC surges ahead.
But interestingly, while MSC is booming, we're seeing a simultaneous slippage from several major Chinese leasing giants. ICBC Financial Leasing, for instance, they slid 3 places in the rankings. Their fleet actually shrank quite a bit.
Hmm. Now, the source material hints at a potential geopolitical reason for that slip. It mentions global political concerns, even referencing the return of Donald Trump. How much weight should we give that? Is that solid analysis or just commentary?
Well, it's important we just report what the source claims, impartially.
Yeah.
It does cite geopolitical headwinds, including the Trump factor, as potentially chilling new investment for some Chinese lessors. But, the data also gives a much less controversial, maybe more practical reason, too.
Yeah.
Many of their assets, their investments, were tied up in new building orders. Ships that were ordered but just hadn't hit the water yet by the time the rankings were calculated.
So it could just be timing.
It's often a timing issue in these rankings, yeah. But the sources are pointing to political risk, maybe making financing these huge long-term assets a bit harder for some players.
Got it. Either way, the overall trend seems clear. Financial lessors may be taking a step back, while the actual carriers like MSC are doubling down.
That's the core trend. And we also see new players emerging, like Belgium's CMB Tech debuting high up. That's thanks to their takeover of Golden Ocean. And other major carriers, like Taiwan's Evergreen and Germany's Hapag-Lloyd, are climbing into the top 25 as well.
So the carriers are buying up assets.
Yeah.
Taking control.
They want total control of the chain, it seems.
Okay, so we've got this picture of massive strategic physical investment happening, ports, ships, the works. Now, here's where it gets really, really interesting for me. All those predictions, the forecasts of a total collapse in container shipping because of trade wars and protectionism, they haven't really panned out, have they?
No, not in the way some expected. The bubble hasn't burst. It's just changed shape dramatically.
It's rearranging.
Exactly. It's not a collapse. It's a pivot, a huge pivot. Demand hasn't just vanished into thin air, but the paths the cargo takes now. They're longer, more complicated, more roundabout, and therefore more expensive.
Which explains why freight rates are still so high, right?
Yeah.
Even with all this new capacity coming online.
That's the key. They remain stubbornly resilient. You'd think more ships, more port space, rates should fall.
But they aren't plummeting.
Not at all. Look at the data from, say, mid-September. Trans-Pacific rates, China to the U.S. West Coast. They were up 24% just month on month.
24%.
Yeah. And the rate for a single FEU, that's a 40-foot box going to the U.S. East Coast,
Yeah.
that includes the Panama Canal costs and complexities, it was assessed at $3,375.
That kind of pricing stability, when a capacity is booming,
Yeah.
it tells you something else is driving costs.
It screams geopolitical friction. That's
Well.
the primary new cost driver baked into everything.
And the tariffs, well, they definitely worked in disrupting the old flows from China. U.S. container imports from China were down 11% year on year. That continues the trend.
Yeah, that 11% drop is really the engine driving this whole rearrangement story. And the really critical finding, this comes from the IW Economic Institute study. It shows the EU stepping right into that gap left by China. EU exports to the U.S. actually surpassed China's in both volume and value in 2024. Think about that. The EU sent $287 billion worth of goods, while China sent $247 billion. The U.S. is strategically becoming more reliant on the EU for certain goods that are harder to get elsewhere.
And basic economics says when a route becomes more vital.
The price goes up, exactly. That increased reliance on Europe. You see it instantly in the freight rates. Rates from Europe to the U.S. jumped to $2,269 per FEU right after those August tariffs kicked in. The market reacts almost immediately to the politics now.
So the U.S. pivots towards Europe. What's China doing? They can't just be losing that volume.
Oh, absolutely not. The other side of this is China's ability to divert its trade. They aren't standing still. Rates to Northern Europe from China are holding pretty firm. And crucially, China is really fostering trade with India now. India's port traffic grew, 4.6% year on year in the first half of 2025.
So the goods find new routes.
They always do. When one political door closes, the cargo doesn't just disappear. It finds new customers, new paths, often longer, more complex paths, but it moves.
Okay, so we've painted this picture. Huge physical investment colliding with resilient, geopolitically driven freight rates. What does this all mean for the immediate future then? This is where we bring in that UNCTAD report, the Review of Maritime Transport 2025. They seem to bring a necessary dose of realism to the whole situation.
They really do. UNCTAD is basically warning the industry to brace itself, brace for a period of pretty fragile growth and just mounting uncertainty. Despite all that massive capacity we talked about earlier, seaborne trade volumes, They're expected to basically stall in 2025.
Stall, like flatline.
Almost. They're projecting a rise of just 0.5%. That's barely moving the needle.
And you can see the cost of all this political risk just piling up in the logistics system. The report points out that all this long-distance rerouting because of various tensions, it led to nearly 6% growth in ton miles in 2024.
Yeah, and that term ton miles, it's really key here. It basically measures how far every single ton of cargo has to travel. So a 6% growth there means ships are sailing significantly farther, burning more fuel, taking more time, just to deliver roughly the same amount of goods.
Which translates directly to
Longer journeys, yeah. More fuel burned, definitely. Sometimes skipped port calls just to try and keep some semblance of a schedule, and ultimately higher operating costs for everyone in the supply chain.
And that whole operating environment still feels fundamentally risky, doesn't it?
Yeah.
UNCTAD is flagging ongoing concerns about potential spillovers from conflicts, maybe disrupting shipping in the Strait of Hormuz next year, like we saw with the Red Sea crisis.
The risk is definitely still there. And the environment isn't just geopolitical risk, it's also the physical environment, climate change, regulations. UNCTAD focuses heavily on what they call the twin transitions, energy and digital.
Right, the green transition.
Exactly. On the energy front, coal and oil volumes are under pressure from decarbonization efforts. Gas trade is still expanding, though. But the big thing is that complying with environmental rules is completely redefining the economics of shipping.
And this is where that capacity boom meets a harsh reality, right? Shipping's greenhouse gas emissions actually went up 5% in 2024.
Yeah, they did. And
Oh.
yet, get this, only about 8% of the world fleet's tonnage is currently equipped to use alternative, cleaner fuels.
Only 8%.
8%. That massive gap, the other 92% that needs upgrading or replacing eventually, that represents this huge, looming financial burden hanging over the entire industry.
A burden that will inevitably get passed down the chain to consumers.
It has to, eventually. The cost of decarbonization is a massive factor in that uncertainty forecast. And then on the digital front, UNCTAD is pushing for more trade facilitation, streamlining customs, paperwork, etc., through digital means. And they highlight cybersecurity. It's not just an IT department problem anymore. It's a critical operational priority for ports, especially as automation increases.
You really can't afford to have a major terminal knocked offline by hackers.
No, the disruption would be immense.
Okay, this has been a really comprehensive deep dive.
Yeah.
We started with just the sheer scale of investment, this capacity boom, the fleet surge, hitting highs we haven't seen since before the financial crisis, all driven by carriers trying to own more and more of the supply chain.
Yeah, and that massive investment then crashes right into the UNCTAD warning. Fragile growth, mounting uncertainty, high freight rates are persisting, not because global demand is exploding, but because the demand that is there is being violently rerouted by geopolitics. It's adding costly ton miles and significant risk to basically every single shipment.
A real clash of forces.
It really is. And, this raises a final important question, I think. UNCTAD finished their report by noting something else. Critical minerals.
The stuff needed for batteries, tech.
Exactly. The raw materials essential for, everything in the digital economy. Batteries, AI, chips. These are becoming a new source of tension in global trade. The volumes being shipped by sea are leaping dramatically. So what does this intense global competition to secure these minerals mean? Minerals often concentrated in just a few places, making them vulnerable to the same rerouting and conflict. How should you, listening, view the long-term stability of supply chains in this digital age? Are we just swapping uncertainty about finished goods for uncertainty about the raw materials needed to make them?
That's a fascinating angle. Trading one kind of uncertainty for another as the world rebalances. Definitely something to think about. Okay, that's it for this deep dive. We'll talk to you next time.